In this video, I'll go over the traditional IRA versus the Roth IRA and the mistake I've made that you would definitely want to avoid. And I'll also talk about the backdoor Roth IRA. I'll provide tips and recommendations along the way, so be sure to watch to the end. Hey, I'm Michael, and I've grown my net worth by $1 million in less than 4 years. And I'm going to show you finance hacks that you can implement today so you can take a step forward towards becoming a millionaire. Regarding the retirement accounts, I've spent around 20 hours doing a lot of research and talking to the Fidelity Specialist to learn more about the retirement plan. I hope you find this information useful. So let's start with the traditional IRA account. So there's 4 things I want you to know. Number 1, you can put up to $6,000 per year. If you're 50 years or older, you can put $7,000 a year. Number 2, there is no income limit. So no matter how much income you're making, you can put up to $6,000 per year. You need to submit the form to your employer to have them take the money out of your bi-weekly paychecks pre-tax. And the good news is you can still put money in for 2020 if you haven't filed your taxes yet for 2021. So you have basically until April 15th to put up to $6,000 into your traditional IRA for 2020. Number 3, the traditional IRA can be pre-tax and or after-tax money. Number 4, if you have a retirement plan through your employer, such as a 401k, there are phase-out deductions based on your income level. So starting at the modified adjusted gross income, or they call it MAGI, of $66,000 for single and $105,000 for married couples. So if you have a 401k and you're putting a lot of money in there, but you make more than the income limit of $66,000 MAGI per year, then you don't really want to put money into your traditional IRA because now you're not able to get any of that deduction. Basically, it's not pre-tax money. Let's go over to the Roth IRA. 5 things I want you to know. Roth IRA is similar to the traditional. You can put up to $6,000 per year into your Roth IRA account. You can put another $1,000 if you're 50 years and older. That's a catch-up. Now, income limit does apply to the Roth IRA. So that is your modified adjusted gross income, MAGI, of $140,000 for single and $206,000 for a married couple. What this means is you get taxed first and then you can put your money into the Roth IRA. So because these are after-tax money, when you do pull out money from this account in the future, you will not be taxed on that gains. Number 4, after having this account established for 5 years, you can actually pull out the money from this account tax-free, but you can only pull out what you have contributed. The gains will have to stay in that account until 59.5. The gains will have to stay in that account. If you do want to pull out the gains, you will be taxed on the gains and you'll have to pay a 10% penalty. Number 5, you can pull out the money once you reach 59.5 years old, and this applies to all the IRA accounts. Now, let's get into the fun and tricky part of this retirement plan. So the backdoor Roth IRA, or also known as the Roth IRA conversion. If you don't have an IRA account, you can actually direct deposit your money from your bank account into a traditional IRA and then convert that over to a Roth IRA. What's nice about that is that these are after-tax money, right? And you avoid the Roth IRA account limitation of income limit. So for me, so for example, if you don't have an IRA account, you can connect your bank account to a banking institution, deposit $6,000 into that account under a traditional IRA account. Like I mentioned, traditional can be a pre-tax or after-tax money, right? So you deposit $6,000 from your bank account, which is an after-tax money. You then convert that over to a Roth IRA. So now that $6,000 is after-tax money, and you won't be taxed on it. And you avoid that income limit like what the Roth IRA provides. So a backdoor is kind of like a back way in. But here's where it gets tricky, the mistake. Here's what this mistake that I made. So I set up a traditional IRA account and I created a Roth IRA account. I also, however, have, through my previous employer, I had a retirement plan there. So when I left that company, I pulled that money over to Fidelity and changed it to a rollover IRA. So because of that, it's considered pre-tax money in an IRA account. So when I direct deposit my $1,000 from my bank account into a traditional IRA account, which has $0 in it at the time, by the way, I did that. And then once the money settled, I did a backdoor conversion to a Roth IRA, thinking that, hey, yay, I avoided taxes and these are after-tax money. But no, I am subject to the pro rata rule. In the eyes of the IRS, since I had $42,000 in my rollover IRA, and then I direct deposited $1,000 into my traditional IRA and converted it. So $1,000 is the after-tax money and $42,000 is the pre-tax money. So as a whole of the $43,000, roughly 2% of that is after-tax money and 98% of that money is pre-tax money. So, because I'm subject to the pro rata rule, any money that goes into a Roth IRA account, those are considered after-tax money. So because in the eyes of the IRS, I put $1,000 into through the backdoor Roth conversion, it's saying, hey, that means 2% of that $1,000 is after-tax money, and 98% of that money is pre-tax money. So hey, guess what? I'm gonna tax you on 98% of that $1,000 this year. So that was my mistake, guys. I'm gonna have to basically pay taxes twice. Because this $1,000 that I put in was actually already after-tax money. And now $1,000 going over to the Roth, I get taxed again. So it sucks. I have to pay taxes on that. I guess the good news is the $1,000, the after-tax money. So in the future, if I reach the 59 and a half years of age and I start pulling out money from my rollover IRA, the $42,000 sitting in there, well, guess what? 2% of that will be after-tax money. So I won't get taxed on that. But the remaining 98% is gonna be taxed. If you find my content useful so far, please like, subscribe, and press that bell notification. That will really help me out a lot, guys. And also, I upload weekly videos relating to personal finance. All right, so let's jump back here. I'm gonna go over a couple tips and recommendations. Once you start the Roth IRA, you need to have that account for 5 years until you can start pulling out your withdrawals without penalty. Here are the tips. So you set up a Roth IRA account, you have to have that account for 5 years until you can pull out your contribution without any penalties if you're under age 59 and a half. The biggest reason I opened the Roth IRA account because I want that clock to start ticking, the 5 years. However, after learning and going through this process and doing much more research, I realized that because my money was coming through in Roth IRA conversion or backdoor, every time I put money in that clock resets at 5 years. So meaning 5 years from now, so meaning this year I put in $1,000, next year I put in another $5,000 to the Roth IRA conversion. So I have a total of $6,000. In 5 years from now, I can only pull out $1,000 because 5 years ago, I only put in $1,000. And then the following year, I then can pull out the $5,000. So the clock resets every time you put your money in through a conversion or backdoor. Here's my recommendation for you. Make sure to do your research and talk to a professional for help, right? So once you're ready, call your investment institution to help walk you through the step if this is your first time. It typically can be easily done online. So I learned the hard way and made a mistake that will cost me money. Luckily, I only put in $1,000 into my Roth IRA conversion, so lesson learned from me. Now, if you're in the lower income bracket, it's typically recommended to put money into your Roth IRA because you're taxed less, right? The higher your income, the higher tax percentage you are. So because if you're in the lower income bracket, it's recommended to put money in the Roth IRA. If you're self-employed, there is no income limit. So I would definitely recommend maxing out the traditional IRA. As for me, since I have a plan through my employer, I do max that out and I'm subject to the phase out deductions if I contribute to the traditional IRA. So for me, I'm actually not going to be contributing anything further at this point into a traditional IRA or the Roth IRA because I don't have any deduction advantage or tax advantage from that. I would only consider putting money into the traditional IRA or the Roth IRA if for some reason my income was dramatically reduced where I would qualify based on my income level. But at this point in time, that's not the case. So because of that, I don't plan to put any further money into traditional or IRA. I hope you found this video useful and thank you for watching the video. Till next time, bye.